Capital allocation is a key responsibility for business leaders because it involves deciding how to use a company's financial resources in ways that create the most value for shareholders. It's not just about spending money but about making thoughtful choices that balance growth opportunities, risks, and long-term benefits. This process includes deciding whether to reinvest in the core business, fund innovation, reduce debt, acquire other companies, or return money to shareholders through dividends or buybacks. The goal is to invest where returns, adjusted for risk, are highest. Doing this well can lead to better financial performance and greater stability by diversifying investments and managing risk effectively, while poor allocation can hold a company back or even lead to failure. The image here illustrates these choices visually, showing how a company's capital can be directed into different paths, each representing potential returns. Overall, mastering capital allocation helps companies stay competitive and deliver sustained value to their shareholders. Proper capital allocation is essential for sustainable growth, as it supports innovation and expansion without excessive debt. One common strategy is reinvesting profits back into the core business, like upgrading technology or expanding production, which Amazon does through its investments in logistics and cloud services. Another approach is debt reduction, which helps strengthen the balance sheet and reduce interest costs. After the 2008 financial crisis, many companies focused on deleveraging to improve financial health. Mergers and acquisitions offer a way to grow quickly and gain market share, exemplified by Facebook's strategic purchase of Instagram. Share buybacks also play a role by increasing earnings per share and signaling confidence, with Apple being a notable example through its significant buyback programs. Lastly, dividend payments provide steady income to shareholders and indicate financial stability, something Unilever has maintained to attract long-term investors. These strategies bring several advantages, such as boosting shareholder confidence, allowing flexibility to respond to market changes, and promoting disciplined financial management. However, if capital is not allocated wisely, it can result in wasted resources and decreased competitiveness. Focusing too much on buybacks or dividends can restrict a company's ability to pursue growth opportunities, while mergers and acquisitions often come with risks like integration challenges and the possibility of paying too much. Looking at real examples, Berkshire Hathaway is well known for Warren Buffett's careful approach to capital allocation, concentrating on businesses with solid fundamentals and good reinvestment prospects, which has resulted in strong long-term returns. On the other hand, Tesla has taken a more aggressive path by reinvesting heavily in research, development, and expanding production capacity, establishing itself as a leader in electric vehicles but also accepting higher risks. In conclusion, capital allocation requires both skill and judgment. Companies that manage their capital well create lasting competitive advantages and boost shareholder value. Successful strategies find the right balance between short-term gains and long-term growth, keep financial flexibility intact, and stay adaptable to changing market conditions. Disciplined capital allocation is a defining feature of thriving businesses and a major factor in building shareholder wealth.